Good morning, good afternoon, maybe even good evening, thank you very, very much for joining our webinar on tokenization goes global. My name is Barnaby Nelson. I run the ValueExchange, it's really fantastic to be able to have not only yourselves, but obviously a fantastic group of panelists here today to be able to spend the next hour talking about exactly what tokenization of collateral really means in practice. So, what are we here to talk about? A couple of key points just to kind of start off with. So several times throughout the last year, regulated firms, so the firms that you can see here today and more, were able to complete live repo transactions on Saturday mornings using dollars, using euros, using sterling. So this whole question about tokenization of collateral, is it a future thing? Is it happening? For me, the most important thing, by the dint of the people that you can see on the screen today, really just underlines that this is very much a reality today. These are all organizations that have done tokenized repos. And so really, the opportunity of this conversation today is for you, the participants on the line, to be able to really, really get everything you need out of this. If this is a practical reality, if this is a thing that is happening, and I think you'll probably get a sense over the next hour that this is past a sense of kind of will it, won't it, then this is your chance to really make the most of the people that we have here, to ask all your questions and to take away from this call, hopefully, a really good idea of the practical implications of what this means for you in your organizations and where you need to go next. So this call is all about you guys, the participants in particular, not to do down the panelists who I'll introduce in a second, but in order to ask your questions, in order to make sure that we get a good takeaway in terms of everything you need to know, there is a Q&A button at the bottom of the screen. It may be hidden under the more. If you look at the bottom of your Zoom panel, there is a Q&A function. Please do log your questions as they occur to you through this, and we'll make sure to ask them as we go through. In order to get started, I'm just going to start sharing a couple of slides really quickly, just to be able to set the scene. Most importantly, everything we talk about today, you can see there are QR codes absolutely everywhere. Everything we talk about today is part of a report that we published around these trades. So if you're wondering what on earth we're all talking about, make sure that you download that really quickly. As a quick plug, before we get into this conversation, if you want to talk about tokenized money market funds, we've got a webinar on that coming up on July the 1st specifically. So, as part of the whole runway, we're talking about collateral now. But if you want to talk about that, then make sure you join us then. But really what we're here to talk about today is the fact that basically, by our estimations, the current way that we move and run collateral today is costing an average firm somewhere in the region of $340 million a year in lost interest. Why? Because we know that basically we have a very manual set of processes. About 60% of firms complain about the fact that collateral exchange and collateral management is heavily manual, makes for massive amounts of reconciliation costs, but more than anything, it makes for the fact that basically around 25% of collateral that's being posted across an average of 65 different locations around the world is basically either being pre-funded or being kept in excess. So basically, 25% of collateral is underperforming today, and that's not even including, and that includes a huge amount of, as I said, of lost interest that gets us to roughly that 340 number. And it creates, therefore, a massive drag on everyone's investment returns, whether you're a portfolio manager, whether you're a bank running any kind of portfolio, it's a real challenge. On top of that, the other challenge problem statement that we'll be digging into today is this whole question of what do you do on the weekends? This whole question of guesstimation, when you have to sit there on a Friday night and say, do you know what? I think this is basically going to take, on Monday morning, I'll probably need this much capital, this much funding. These are all the problem statements that we found coming into the whole kind of these trades. And as I said, when you're talking about hundreds of millions of dollars of costs, they really end up mounting up to a really, really good reason to get a bunch of people together and to do some really cool work. So what's happened? What are we actually going to talk about today? we'll go through it in much more depth, but the recap is basically, as I said, over three times through three waves of trades in the last year, there have been a huge number of real marquee name organizations conducting live repos on weekends using real securities and real cash. For me, the flags are probably one of the most important thing. That what started as an America and US dollar only kind of setup has now gone across the pond, if you like, and created 19 hours worth of zone of intraday movement. And it's that cross-borderness that we're going to be talking a lot about today. How was it? We'll talk about through this conversation, we'll talk about roles and responsibilities, but ultimately, all of this was conducted on the Canton network, leveraging all the different roles and responsibilities that you can see here. PBs, investors, CSDs, technology providers. And what's amazing is that we've got everyone here today to be able to talk about that. Where does this end up? I'm going to leave the panelists to really talk about this a little bit more. But for me, what is so compelling about this is that actually we are now starting to see real outcomes come out of these trades. We're starting to see real evidence of what is actually happening to firms. And you'll hopefully have noticed through this entire introduction, I haven't used the future tense once. All we're talking about today is present and past tense. And so for me, this is where I really want to be able to hand over, having just set the scene briefly, to an incredible panel to be able to talk in the past and present tense about basically what's going on around tokenization of collateral. So what I'm going to do is just go around the room and ask each of our panelists to introduce themselves briefly, but also just to give us a quick view of when we were sitting here a year ago or sitting together a year ago, what was it that actually got everyone in the room? So in the knowledge that there's a lot of people on the call who are probably thinking, should I, shouldn't I? What is the compelling event? We're going to just basically go around the room and start there. And then what we're going to do is we're going to walk through from here, how we delivered, what is the roadmap, what are the details of actually what we've achieved, and no great surprise, tokenization in 2026, what's the runway? So long intro, but Dan, going to come to you straight away. This time last year, what were you thinking when you were saying, okay, do you know what, we've got to be doing these repo trades?
Sure. I'm Dan Eckstein. I run fixed income distribution at Virtu Financial. Thank you so much for having me. So if for those who don't know Virtu Financial, we are a global market maker that provides liquidity in markets ranging from equities and ETFs to crypto and prediction markets. We've always used technology as a way to advance market structure and bring efficiency to the marketplace. And over the last year or so, we've seen a lot of interest in new marketplaces that are extending the normal business hours from the traditional market hours to 24/7, things like prediction markets and crypto. And we've really looked for solutions as market structure began to unfold. Like, how do we handle this migration operationally? What does that mean for the broader organization and our customers? And we came across this working group with Canton, which were really partnered with some of the key components and organizations that we work with today that we're trying to find solutions where we can leverage the Canton network and blockchain technology to add efficiency to the marketplace. So we looked at it as an opportunity to work with our partners and digital assets in Canton to find ways where we could mobilize collateral in real time, allow us and our trading operation to be more efficient, and also find new opportunities to work with our customer base.
Brilliant. Thanks so much, Dan. I love the fact that this is a response to something that you're already seeing, the kind of 24-hourization of the markets, that essentially this is not, as well, I think we'll see from everyone, this is not a tokenization just because it's tokenization. This is actually how do we respond to something that's actually already happening. So Liz from Tradeweb, if I may ask, what was your take?
Of course. Hi, thanks for having me, Barney. I'm Liz Kirby. I'm the head of market structure at Tradeweb. For anyone who is not familiar, Tradeweb is a leading execution platform focused on electronic trading of instruments, including fixed income, equities, money markets, and derivatives. We've been around since 1998. And our company has always kind of focused on leading through innovation. initially that innovation was bringing electronification to markets that were historically traded via voice or more traditional means. And so with sort of the advent and evolution of blockchain technology, this felt like a really kind of natural place for us to lean into from an innovation standpoint. Now, to answer your question very specifically, Barney, what made us really excited a year ago is that this was a use case and a blockchain, both, that made a lot of sense for institutional financial market applicability. And so by that, I mean, why focus on collateral mobility? A lot of the reasons that you just mentioned on the slides that you showed earlier. I think we were very focused on, identifying a problem that can actually be materially improved, where efficiency can be added into these markets in a real way, not just sort of, innovation for innovation's sake or proof of concept. Let's really do something that adds efficiency into the market and into our participants' ability to access the markets. And then again, with partnering with the Canton Network as an institutional market provider, there are so many things around sort of information, privacy and permissioning that are just table stakes to participants being able to exchange risk and do their business. And so finding a blockchain that allow us to move forward with offering, on-chain execution with the benefit of all of these really necessary elements for, institutional risk transference was really critical and super exciting, and very excited to talk about how far we've come since then too.
Yeah, magic. Thank you so much. So Bud from LSEG, obviously this is this is a fascinating, I think, opportunity in many ways. So what was your take in terms of when you looked at the Canton trades, you thought, what, this is a really great opportunity to further all the work that you've been doing?
Sure. So, Bud Novin, I run payment systems for LSEG Post-Trade Solutions, as well as our Dish initiative. I think for a while we had been seeing that there was a lot going on and being talked about in the tokenization of assets space, but we just didn't see there being a fit for purpose TradFi cash solution. Stable coins great all to all, but at the end of the day, it's a basket of treasuries and isn't cash. Can't use it to meet a clearinghouse call or contractual cash flows, but has a great all-to-all component. Commercial bank money is what gets used in TradFi, but it's limiting because you have to be a client of a bank. We had been running a bilateral clearinghouse, which is an essential counterparty, and swap agent, which I led the design of that payment system, and we just saw a great opportunity to bring that to the real-time settlement space. We thought intraday FX, intraday repo, great opportunities. And we essentially do provide a token for commercial bank money on exchange, but anybody can pay and receive it as long as they sign up to a rulebook. You don't have to have accounts. So the Canton solution seemed to make a lot of sense for us because it's a place where we can bring an all-to-all cash solution to a host of TradFi clients and meet a place to meet tokenized assets. So it was compelling for us, and we've been really excited about it.
Yeah, no, brilliant. Thank you. So I think for me, what's fascinating is between Liz and Bud, what you're saying, you've got this brilliant ability to actually transport current ways that we work into a new technology, into a new network, but ultimately, as you were saying, Liz, really addressing kind of foundational challenges. So Joe, I think DTCC is doing some stuff on tokenization, from what I understand, possibly, maybe.
Yeah, no, that's possible.
Yeah, maybe I read something about it. Do you mind just maybe, obviously there's a thesis to be written here, but your take in terms of actually the runway of what's being kind of coloring your thinking over the last year overall?
Yeah, so Joe Spiro here from DTCC, Digital Asset Solutions team. And we're focused on our tokenization service, tokenizing essentially the US market. We have over 115 trillion in inventory. That's essentially the entire US equities market. and then plenty of fixed income instruments as well. And so providing that tokenization infrastructure is really the focus right now. DTCC has been the financial market's biggest infrastructure provider for over 50 years. Back in the 70s, when we had the paperwork crisis, you had many transfer agents, issuers, brokers all dealing with each other. The settlement cycle was T+5, 5 business days to be able to agree on ownership. DTC was established to be able to step in and bring that settlement cycle down to T+3, and then T+2, and then finally T+1, where we are right now. But we can do even better. And so tokenizing assets and providing that infrastructure to be able to use blockchain rails for collateral and many other use cases is really sort of the next phase in our industry. And DTCC is focused on being here to provide the same safety, stability, investor protections, compliance controls that the market has grown accustomed to for the last 50 years.
Brilliant. No, look, thank you. And so we've kind of got, hopefully everyone who's listening can start to see, depending on your job description, you can start to see commonalities in terms of things that apply to your jobs. But when we actually switch over to outcomes, Joel from B of A, you're as in the PB space, obviously you're a service provider, you're a GCM, margin, collateral, existentially important. How is the trades meant to change your life?
Yeah, thank you. Thanks for having me, everybody. Joel Stainton, I'm responsible for the F&O and OTC clearing business of Bank of America in EMEA. I'm also responsible globally across the clearing business and repo for collateral interest and liquidity. So tokenization, something I spent a lot of time thinking about. We spent a lot of time thinking about. Barney, to go back to your question about what were we thinking a year ago, the value extraction is real when it comes to the inefficiencies associated with moving real world collateral. That's across whether it's clearing, whether it's under a GMRA for repo, whether it's under a CSA for swap, for swap margin. That movement is insufficient, is inefficient for our clients. The ability to post the cheapest to deliver against any margin requirement becomes challenging when it's 24, 48 hours to substitute. You're waiting about the settlement times. So there's a financing demand there. And for us as a clearing member, we're processing work where we can add no value and extract no value. We're just processing collateral in and out. So that the value extraction possibility was very real. I would echo what Liz said. Then we started seeing a year ago some pretty significant regulatory tailwinds, some more favorable regulatory outcomes, which have solidified themselves over the last 12 months. But certainly, talk of no action relief, a direction of travel from global regulators that supports tokenization as distinct from crypto. That was very important. And I would say that then also echoing what previous panelists said about the technology, I think when we think about what a receiver of collateral does, at its core, that collateral receipt de-risks a loan of some kind that we have provided on behalf of our client for something they're doing. And the technology to speed up the movement of the collateral has existed for some time. What came to pass around a year or so ago is that the technology, the private blockchain technology, the regulation, the rules, etc., allowed us to speed that up without increasing risk. Prior to that point, you could always speed up movement, but you lost sight of the collateral. And the point about what is that collateral doing? It's de-risking a loan. It means in the event of any default, I need to seize that collateral and liquidate it. That's the whole point of it. And in order to do that, all the law in the world says I have to have 100% operational control over the collateral at all times. So speeding it up always came with that risk until what we put together came along, and it was solidified around that to say, okay, the value extraction is real, the regulatory tailwind is real, and we can see the direction of travel. And now we've got a way of speeding up collateral mobility without losing operational control, and that is the key thing for us.
Yeah, absolutely. Fantastic. And so, unfortunately, Chris, I'm assuming anything that's ever in alphabetical order, you always end up finding yourself on the tail of these. But from a DRW perspective, you've got all of this technology that's at your fingertips every day, all of the service providers. In terms of outcomes, what were you looking at from, as to be able to piggyback off what everyone said in terms of actually how does that manifest in terms of outcomes?
Yeah, so the enviable position of trying to say something new after seven
That's
people
right.
say all the
Yeah.
things I wanted to say. But Chris, DRW, proprietary trading organization, active globally across many markets, including Cumberland, which is our crypto asset trading operation. So when we kind of asked the question about like what we're thinking, a year or so ago, our process started more than a year ago. We founded Cumberland as an OTC trading business back in like 2014. And Don, our CEO and founder, co-founded Digital Asset to work on building blockchain solutions back then as well. And when we entered into the space originally, it was very clear that this was a powerful technology for the movement of value. And if you spent any time in traditional capital markets, I think very quickly you recognize a couple problems. One, collateral management leads to very inefficient balance sheet management due to the kind of the constraints on when things can move and how you can move and pre-positioning and whatnot. But also like the inability to move it in near real time represents a real 24/7 represents a real kind of headwind to risk management in the industry. On the other side of it, trade financing, you're kind of limited to the pace at which traditional capital markets rails work, forces you to, as a previous panelist said, make kind of inefficient decisions about how you fund your transactions, how much capital you draw, that sort of thing. And so this idea of being able to use the blockchain to tokenize the proper assets, to move them, mobilize them in near real time to facilitate better collateral mobility and risk management and financing was kind of always a core premise of how we thought about things. But the reality was, in order to do that, you need the right primitives. Right? You need a blockchain with privacy, composability, kind of auditability, et cetera. And Canton solve for that problem. It's all table stakes. You need the right assets and the right asset issuers. You want to make sure that the assets you're issuing on chain are legal title preserving and bearing, that you have the ability to, as Joel said, make sure you have operational control throughout the process. You want to bring the CSDs in as the issuers in order to kind of facilitate the process appropriately. But then you also need all the right service providers. You want the traditional primes and the banks and the platforms all to kind of do what they've always done, just on a more efficient infrastructure. And so that kind of all came together about a year ago. All this work over years for many different organizations kind of culminated in this recognition that the pieces are in place, the technology is there, and we are moving away from a world in which innovation was kind of like frozen, right? It's very difficult to innovate in capital markets. But all of a sudden, because of the DeFi innovation, because of the way these major industry leaders are leaning in, we're faced with the opportunity to change the way this works fundamentally. And so last year, it was, let's prove it. Like all this talk, all this investment, all this engineering, all this operational build out, let's prove it works. And so we did these first trades. And I mean, we'll probably talk about this a little bit later, but remarkably smoothly on a weekend with a very quick turnaround time. So like, I think we hit that, like really proved that it works, and looking forward to seeing what's next.
No, brilliant. Thank you. And I think for me, what's great, even from what, if I just have, knitting it all together, for me, what's so great is that, as you said, Joel, this isn't really about an absence of technology. It's about the fact that, that the coming together right now, as you said as well, Chris, of everything, regulation, the group, the technology, everything, the fact that it's coming together, it's far more than just basically just some new piece of kit, something, that suddenly everyone can roll out, that there is this coming together right now that, back down to your point, you've got a lot of macro trends that are basically making that coming together even more compelling than it's ever been. So, I mean, I suppose to then swing it round, and I'm going to ask actually, just to give them a warning, maybe Chris actually leaving off from your point, and Dan and Joel, outcomes. I mean, you said, Chris, it all went very smoothly.
Hmm.
When you actually, so as you said, the repo is great, fantastic. Everyone finishes high-fiving each other. When you go back and think, okay, so a year on, why are we better off now?
I mean, if you're asking me first,
Mm,
I think for us there was um, a recognition that it is possible is an important and critical step in all this.
mm,
But applying it to the business use case obviously matters
mm,
as well. And one of the things that I think we've seen a dramatic shift over the course of the past year in is this concept of 24/7 markets.
yeah,
I remember when some of these conversations first started, whatever years ago. They said, okay, well, people don't work the weekends, and I always said, well, come on, like let's be serious. Like
yeah,
if a kinetic war breaks out on a Saturday, like your oil traders aren't like going to the grocery store, they're watching the screens and waiting for the markets to open back up so they can manage their risk. And your CROs are doing the same thing. Um, but they always say, well, it's just crypto, right? Crypto trades 24/7, but not much else. And we kind of always said, well, the change is coming. Like
mhm,
global markets are continuous. Risk management is continuous. It's just that the tech and the ops haven't gotten there.
yeah,
And and lo and behold, in the past year, we were faced not only with kind of exactly those scenarios, like wars and weekend risk management and whatnot, but now we have markets moving 24/7. And in some cases before, the ability to move and manage collateral around those trading activities.
mm,
And so when we kind of talk about what's next, I think we absolutely continue to build out and scale the existing capabilities, but it is
mm,
applying it to those use cases that are clear and present for everyone today. And so
mm,
as a trading organization, our ability to finance our weekend trading in a more efficient manner, allowing us to sit in yield-bearing assets up until the moment to trade and then repoing it out to get the cash to deploy and then unwinding, et cetera, is like that's the efficient frontier of trade financing. That's a
mm,
very fascinating capability for a trading organization. Um, and same with kind of just movement of collateral in general for whether or not it's counterparty trades, is the government derivatives, anything for that matter. Just the way we
mm,
think about risk 24/7 and the balance sheet deployment to facilitate these transactions is leaping to the efficient frontier. And so
yeah.
all of our traders and all of our treasury teams are starting to think in that context.
Mm, yeah, yeah, fascinating. That mindset shift is it's really now that it's possible, suddenly you just move on. Yeah, yeah,
Yeah.
yeah. Oh, that's fascinating. So Dan, I mean, obviously, we talk about these trades as if they're one block, but obviously this is a journey of many steps and many phases. I'm curious in terms of major milestones, again, from a outcomes perspective, what do you see as the major milestones that you feel you passed in the last year?
Yeah, I think Chris touched upon a number of them, but from our perspective, I think one of the things that was most interesting to Virtu when we were approached with the opportunity to join this working group, it was around the broad goal of real-time collateral mobilization. And that applies to a lot of different areas. And I think like through the course of these pilot trades that we did last year, we demonstrated that this is definitely a possible outcome that we could be proud of. We proved that. Um, and from that, there was a lot of fanfare internally about what we accomplished on those Saturdays. And I was able to sit down with different parts of this organization and walk through what we did, what this meant, who we did it with, and what are the next steps, and where can this technology actually apply to some challenges that you're facing in your individual business. So some of those conversations, I talked initially around trading that has gone, towards 24/7, like crypto, prediction markets, things like that. That was an obvious place to start, but some of the most engaging conversations were really with my treasury department, with our ops department, people who weren't necessarily clued in on what we were working on from day one, but heard about what we were doing and started thinking about, all right, well, how can I actually leverage this? There are times where I have an intraday margin call. I can see this technology being really, really useful. And talking to our treasury department, who's responsible for meeting collateral and margin obligations in so many different markets throughout the globe, all day, every day. How can I make that process more efficiently? What were some of the actual examples that we had as an organization where we failed to meet those? And what did we learn from that? And how can this actually provide a solution so that doesn't happen again? And it led to more questions. And what I thought was really, really cool was how engaged everyone was in that process. And we're looking to learn more and to find out how this could be applicable. And, maybe this is a good segue into, some feedback from Bud, but some of the conversations that we had from like our treasury department was, this is really neat. You did this with a stable coin. One of the concerns I have as a treasurer of a large organization is, I could move stablecoin from one place to another globally whenever I need to in real time. Fantastic. But how do I quickly and easily on chain and off chain that? And through this working group, the amount of people that we brought together with a common goal and the innovation that is taking place, not just through, things like the Dish Network and what Tradeweb is bringing to the marketplace in terms of the ability to actually process these trades and execute them electronically, but it really is working with people that we're accustomed working with to find these solutions. And I think that was a great outcome, and we're just scratching the surface.
Yeah.
Thanks for that, Dan. I think yeah, it's a really important point that Dan makes. We think a huge part of the repo market is probably for intraday liquidity needs. So having an intraday repo product will be cheaper and more efficient for both the borrowers and the lenders. But if it could only settle in a stable coin, it doesn't really help, necessarily entirely, because one of the main reasons you would do an intraday borrow is because you need to get some cash to a clearinghouse. You have timed settlements. Otherwise, you would just wait till the end of the day, and your net position would work out. So if you're borrowing for time settlements and that time settlement's a margin call at a clearinghouse, you can't use a stable coin to meet that call. Whereas what we're doing is we're providing a true one-to-one commercial bank money solution. We have cash that sits at each of the top commercial banks, and our rulebook allows people to pay and receive in that. So even if one end of the trade doesn't bank at bank X, but the payer delivered a bank X token, well, LCH has an account at bank X, and we can meet your margin call for you. So it really becomes an efficient way to do your intraday borrowing in collateral that you're comfortable with, and that you believe that you have a perfected security interest in, and a cash solution that's instantly convertible because it is cash.
Yeah, that's a really great point. I mean, I think for me, it's easy very much, given the repo use case, it's easy to focus on moving the security side of it around, but actually making sure that, as you said, that there is an institutional grade choice, I suppose, and best in class on the cash side as well, so that basically we're not, the group here has been able to experiment with stable coins, with tokenized deposits, but ultimately to be able to actually see the balance of power between them, and to see the use in a regulated, et cetera, context. For me, the practical experience that everyone's talking about coming out seems to be a huge thing, and I was just thinking, Joe, from a DTCC perspective, obviously all the work that you've been doing in the last few months, for me that, in terms of outcomes, back to Chris and Dan's points, this change in mentality, this growing experience, it seems to me like that's one of the biggest reasons that anyone would be working on DLT right now, is that, the intellectual capacity that you're learning and having your hands on the kit is a major outcome. Do you think that's fair?
It is. Yeah, no, it is. I think another thing that Dan pointed out, he just sort of mentioned it casually, but I think it's a really important point, and that's the whole idea of being able to off-chain and on-chain assets. One of the things that hinder people, sort of to your point of learning more and becoming more comfortable, is that the idea that once you bring your assets on chain, you certainly get to take advantage of all the advantages of blockchain, and that's great. And Collateral is a prime example of where a lot of those benefits sit. But people think they're essentially leaving behind all the benefits and the deep liquidity, the much, much deeper at this point liquidity that you have in the traditional financial market. That's one of the core tenets of what DTCC is trying to do with our tokenization service is provide that interoperability between old and new. You can tokenize an asset that's in your DTC participant account and put it on chain. You can put it on the chain of your choice. So in that way, we facilitate it cross blockchain interoperability as well. But then if you want to, you can detokenize it and turn it back to traditional form. So if you have a use case, so for example, Collateral, as we're talking about here, which is of course my favorite use case, having spent almost 30 years of my life in Collateral, I can talk to you for days about the benefits of on-chain Collateral and how I think it's the best first use case that we have. You can use your assets in those use cases on chain, and then to the extent that you want to sell the asset, you can pull it back. You can transform back in traditional form and take advantage of the deep liquidity in the traditional market as well. So we're trying really hard to focus on that interoperability, not only between blockchains, but between old world and new world, so that we can all get there together in sort of a crawl, walk, run, as opposed to a big bang, because that would scare off most people, I think.
Yeah. And that tracks back in my mind to Bob, what you were saying in terms of, this is people want to be able to have their hands on fiat cash. That the whole thing of it is about, the coexistence of old and new at the same time, and using the way that people work in terms of current securities, current cash, and just basically being able to actually deliver all the funky stuff, the mental mindset change that Chris was talking about, but ultimately whilst acknowledging that we've got a whole bunch of stuff that we need to bring with us.
Yeah, we see it and very much the same way DTCC does, and we're excited to be able to have a place we can go, connect to them, or our clients can. But yeah, when someone receives our cash, they can burn that, then they have cash at a commercial bank. If they want to then mint that on another chain, they could do that too. We're chain agnostic. So we're working much the same way.
Yeah. So Liz, if I may come to you, I was thinking about this whole thing. So it's for lots of great benefits, lots of great outcomes, but I think some key considerations already coming through around old and new. From a roles and responsibilities perspective, obviously you were sitting right in the middle. What as a trading platform, and obviously being able to actually make these repos happen. What did you find that you picked up along the way in terms of experiences around the roles and responsibilities, and how that shifts kind of today versus or yesterday versus today, if that makes sense?
Yeah, absolutely. I think firstly, I would just repeat what Dan and Chris both said, which is that the trades that we've done to date have worked like really, really well, which is great. That doesn't, however, kind of negate that a lot of work went into making sure that those trades worked really well. And it was a lot of work on the part of a number of different participants, including Tradeweb. And I think the good news is, for looking forward, that we have so much kind of knowledge and experience now as a platform operator that, those who are kind of stepping into this tokenized trading workflow now have the benefit of sort of taking advantage of all of that groundwork that's already been laid. And so I think that bodes really well for sort of like the future state of these markets. Certainly the work that the DTCC is doing is going to be such a powerful accelerant to everything that we've seen so far. And so I think we're only poised to see like some really meaningful growth and a pretty serious inflection point. But to the point that was just made around sort of traditional assets and traditional trading sitting alongside on-chain and tokenized trading, that I kind of can't emphasize that enough as being of critical importance. Because we're not just going to flip a switch and suddenly everything will be tokenized. This is going to be kind of an evolutionary process in which, some asset classes, some trade types go tokenized more quickly. Some might evolve a little more slowly. And we want to make sure that we're being responsive to, real market needs and moving this along, in the right way to preserve, liquidity and market function, of course, kind of above all. So the ability to have partners like DTCC and Tradeweb who can provide access to tokenized markets as well as traditional markets all in the same place, I think should really give a lot of comfort to market participants, that they they can rely upon a lot of their existing workflows, certainly existing processes from a platform perspective, even things like onboarding processes. So much of that is already done for participants. And then for things that aren't yet done or things that might be a little bit different, as I mentioned, we have kind of the benefit of a lot of knowledge now and experience in terms of how we can help guide market participants towards, being able to do this in a pretty efficient and pretty rapid way.
Yeah, absolutely. Maybe just to drill into maybe Joe on this point about the kind of the old world and new world point, because there was a question in from one of the participants kind of saying, does the whole on-ramp, off-ramp piece not negate the benefits of everything we're talking about? Does it not, are we not just creating new frictions? I was curious to see what you felt about that, given it's particularly obviously in the collateral space.
Yeah, I mean, from my perspective, it doesn't create new frictions. It's the opposite. It helps to ease some of those frictions. When you have assets on chain, for example, in collateral, you have 24/7 instantaneous settlement. If you can have a DVP with atomic settlement, you have transparent movement that is evident immediately. If firms are using the blockchain as their ledger, then it makes reconciliations irrelevant. There are many use cases for on-chain assets, and then of course there are many use cases for traditional assets as we've been living with them forever. And the ability to quickly and easily transform back and forth from digital to traditional and back again is what really sort of unlocks everything. Because to the point, you in order to facilitate that the true optimization, you have to have the ability to do that. So that's why the DTC tokenization service is designed with that in mind, that you can quickly, at the speed of the network, transform it into a token, use it in a DEX, use it as a DVP settlement, use it in collateral, and then if you need to transform it back, you can do so just as easily. So it gives you really the best of both worlds.
Yeah,
I think there was another question. Now that you mentioned that there was another question in the chat about what will it take to get off of pilot programs and onto real production. And I think that's a really, really important question when where we are at this point in the market. And I've got a pretty good answer for that one too, as you know, Barney, as you sort of alluded to earlier. DTC is rolling out our tokenization service this year. We're going to have a single day pilot in a matter of less than a month, where we will, in production environment, demonstrate lots of these use cases that I mentioned, including a DVP with atomic settlement, collateral pledges, use cases where people can tokenize an asset so that it can be used on chain and then transform it back and use it in a traditional form as well. All of that is going to happen in July. And then in October is the day one rollout of the service for go forward production. So at that point, the service is open for business. And again, this is all for real world production use cases, not tests, not experiments. This is all happening. And in your open, you said you're not saying anything in future tense, you're saying it in present tense. And this is very much present tense.
Yeah, no, brilliant. So, Joel, what does that mean for you? I mean, so we're talking about, as you rightly said, there's this coming together of all these fantastic things right now. You now have the world's largest market infrastructure basically saying, okay, right, this is now present tense. But coexistence is going to be pretty fundamental, both on the cash side and on the security side. How does the rubber hit the road for you? Because obviously, it's not like we're just going to suddenly just overlay tokenization on everything. There are hotspots, right?
Absolutely, and I would agree with what Liz said earlier as well about that rollout piece. Look, the key difference from our perspective between a proof of concept or something that sits in a sandbox and a real test trade is the fact that at that point it's real regulation, it's real lawyers, it's real money. And the risk management of that, whether it's our reputational risk, whether it's our risk in front of regulators, is real as opposed to a proof of concept. Right? That's the key difference. And exactly as Liz said, the 20-minute trade takes 2 months of planning to pull that together. That's notwithstanding, it absolutely went well, but a lot of work went into making it go well. And I think 2026 remains the year, predominantly, notwithstanding what Joe just said, 2026 really remains the year of the test trade. 2027, to answer your question about what comes next, well, then that's minimum viable product. I think that's, the October launch on the horizon from DTCC is a key part of that, and there'll be some other applications across the street, as you say, sort of the hot pockets of moving from test trade to minimum viable product in certain key use cases. The ones that are sort of top of mind are probably intra-affiliate repo, probably intraday repo. What it's not, in our opinion, is a portal, and I'm not suggesting anyone said this, but it's not a portal to 24/7. It's not a portal to complete interoperability. That still feels some way off. And there's a couple of key reasons for it. One is the regulatory framework still remains less clear than we need. No action reliefs are not permanent. Sandboxes are sandboxes. Draft reports are draft reports. And that's the US, the UK, and the EU regulatory landscape today. So it can't accelerate, and it can't really get to MVP until and unless those aspects are clarified. Now, I've talked previously, I think the direction of travel, we think the direction of travel is very positive. The direction of travel is clear, but it is only just that at the moment. It's a direction of travel. So we can build with some confidence. We cannot scale until the regulatory landscape is absolutely crystal clear. Interoperability is key. Again, we've talked about a number of blockchains. We talked about some pockets, but interoperability we're still some way off from that. And other legal concepts around settlement finality in all cases, in all jurisdictions. US and UK law works on case law. No one's gone to court yet, really, to prove this stuff out about settlement finality. So we've still got a lot of work to do there from a risk management and prudential management before this can really, really scale. With respect to sort of it's not a portal to 24/7, again, think about from the perspective of an FCM, GCM, the receiver of collateral. What's that collateral doing? It's de-risking the loan of some kind that we talked about earlier. It's great, and it's definitely preferable to be able to receive collateral when traditional markets are closed. That's definitely a benefit. But today I can't do anything with it. We've talked about on-ramp or off-ramping. There is no real viable secondary market in tokens. I can't sell a tokenized money market fund other than back to the issuer. OCC are suggesting Circle have 7 days to liquidate back to fiat. That doesn't help. In the event that my client defaults on a Saturday morning, I can't do anything with the token until Monday. That's basically, I've got the token, which is better than not having it. I'm still running a 4-day margin period of risk with 2 days of margin. That's not a good outcome. It's not a good enough outcome to really scale into 24/7, to scale into it beyond MVP. So from our perspective, the journey from proof of concept to test trade, incredibly important. A lot of work beneath the surface to make those trades work. Trades coming up are very similar. The journey from test trade to pockets of MVP, minimum viable product, very important. I've described what we think they're going to manifest themselves. The journey from minimum viable product in some pockets to a universe where collateral moves around, I can accept and most importantly, I can liquidate with certainty across multiple jurisdictions. I think we've got time measured probably in low years before that really becomes and really manifests itself across the financial services ecosystem that we're part of. Notwithstanding, at least one of the rate determining steps is that absolute regulatory clarity that we've described.
Yeah, absolutely. No, thank you so much.
Let me just comment on that, if you don't mind. I think Joel makes a lot of really, really good points. Just to be absolutely clear, when I was discussing the rollout from the DTCC's tokenization service, we're not running a sandbox, right? It is a production service, and a lot of the things that Joel just mentioned, while spot on, I think may be resolved through adoption. I can tell you that the demand that we have received for adoption on day one is off the charts. It's more than I would have imagined. So he's absolutely right. It's going to take trial and case law and liquidity, et cetera, before we get into a space where digital is equivalent to where we see the traditional market, and that certainly will take some time. That being said, the reality of this and the production level efforts and the fact that we're going to bring this to production and have a lot of volume in a relatively short period of time, I think is definitely the case. And I think we're going to see that evidenced before the end of this year.
No, 100%. I think for me that the theme is very much this is a journey of 1,000 steps, and at the end of the day, there's no point in standing on the sidelines waiting for all the steps to be completed. Ultimately, it's one step at a time. But I love, Joel, the phasing of it, kind of like this is a wave of gradual one step after the other. And as you said, Joe, you've got a lot of people taking those steps this year.
Yep.
So, but quick
Liquidity
question.
comes with adoption, bottom line.
Yes, yeah. And
And what
also
I
it
would
makes it
add,
harder to
sorry,
stand on the sidelines.
what I would
Sorry.
add to that though is also,
Mm.
innovation breeds like creativity, and
Mm.
and I think what we're talking about here is, previously there wasn't really a path to innovation. There was just roadblock after roadblock, whether or not it was technical, operational, regulatorily, whatever. But now there is a path, as Joe has highlighted, there's many things to be solved, but there's a path for each of them. And those open doors, I think, are driving people to innovate and build the solutions necessary to address the points that Joel has raised. So it feels
Absolutely.
like everything about this is much more real in the past year than it was 3 years ago, partially because of that path to adoption and to problem solving.
And, and we fully agree that it's that path to adoption, Chris. As you said, the path to innovation. We talked about that technology piece being there. The path to adoption for sort of traditional finance is definitely there. That's why we're participating. That's why we're actively engaged with the folks on the call here and other pilot programs, and why that minimum viable product launch in October is incredibly meaningful. And say it is a path. I suppose that's to sort of re-underwrite the point when it comes to the prudential and regulatory risk management that we have to be subject to. It's hard to scale under a no action relief that can expire or does expire. It's hard to scale under a Dear CEO letter from the Bank of England. It's hard to scale under a draft report from ESMA. It makes building and persuading and budgeting and testing much easier, because the pathway becomes much clearer. But yeah, I think an industry call to quickly resolve any regulatory ambiguity it would be very helpful.
Yeah, absolutely. And I think for me, what's you can already sense the kind of the great thing about all the different types of organization that even on this call, you've got the, the heavily regulated Bank of America sitting there basically saying right across every single jurisdiction, I can take one step forward. And at the end of the day, that resilience, that compliance mindset is just, it colors every single step that we take on this journey. But quickly on the cash side, we've had a lot of questions about, you've obviously got an explosion of a risk of making things worse before they get better, almost, in terms of, an explosion of tokenized deposits, stable coins. You've got a lot of innovation going on the commercial cash side, but question marks about what the follow-up's going to be on the wholesale side. I mean, how do you, when you're having conversations with firms about just how they just get on with it, how do you knit all of that together?
Sure. So we see ourselves primarily as an enabler for commercial banks, whether a commercial bank has its own token that it wants to put on chain, or it wants us to open one of our trust accounts, which is bankruptcy remote, and to put a token on chain, a dish token on chain, which represents their commercial bank money. We can operate either way. I think down the line, it's very possible that all the banks have their own, and that for a bank, interacting with its own customer, it's using their on-chain bank token. Where we see ourselves is we will be a member of all of the bank token initiatives, so that each bank and doesn't have to join every other bank token. And we'll probably be an interoperator of individual bank tokens. So, when Joel wants to lend some money to a client at another bank, maybe that bank in between takes ownership. We hold a token, the BAML token, for the benefit of Bank X, who then prints a token to its customer. So by joining all of the bank token networks, I think in the future, there's a lot of opportunity to have really seamless instant interoperability on chain. But for now, we're helping banks get onto chain very quickly to be able to start doing some lending and maybe in advance of how quickly they could do that themselves.
Yeah, yeah, yeah. And I think there's an air of pragmatism about that that I think for me it echoes what Joel's been saying as well. I think that so obviously we've had a lot of fantastic questions and hopefully we're trying to get through some of them, but thank you for raising the questions. So Liz, a couple of while we just almost closing comments, I suppose, actually already. But what do you see as the runway now? I mean, we've talked about, we've talked about where this is. We've talked about present tense. So allowing ourselves a minute to use the future tense in the next 12, 18 months. Where does this go? I mean, we've talked about POCs, MVPs. Where do you see as the pockets of where this can actually can move and maybe not move?
I mean, as mentioned, I think that what we're collectively doing with the DTCC for their pilot program is going to be, in my opinion, transformational to adoption and growth in everything that we're talking about and across asset classes. Really, many, not all, but many of the trades that we've done so far on our platform have been repo trades. We have had some outright buys and sells of government bonds, but I think with the in conjunction with the DTCC and of course all of the participants who are enabling the forward progress, I think we're going to see like a really rapid expansion of both asset classes as well as the set of participants and the types of participants. And so as those things happen, I think we'll learn a lot about the specific use cases and the way that different types of market participants are adopting different, types of tokenized trading for different asset classes. And that'll certainly inform the roadmap going forward. But I think we're poised to see like a really informative and as I said, really kind of like transformational moment over the next couple months where we're going to see, I think, a real explosion in adoption that will hopefully kind of move us all collectively into or at least closer to a business as usual type of interaction in these assets.
Yeah, yeah. And so from an outcomes perspective, Dan, I mean, how do you see that? I mean, if you go back to those people that you were talking to through your organization this year, the operations, the treasury guys, and saying, okay, look, better is coming. I mean, how do you see the manifestation of better kind of actually materializing, with DTCC work, other work over the next little while?
Sure. So I think that there's two outcomes that I'm looking for between now and the end of the year. The first, after the pilot day that goes live with the DTCC next month, I think that is going to be received very, very well by the marketplace. And I think between that day and October for the full go live, what I'm looking to see happen is a lot of interest from a lot of counterparties that may not have been part of this initial working group who see the potential here for all the use cases that we're going to be able to demonstrate next month. And I would like to see growth of different liquidity providers for different types of trades, PBs who can, get different counterparties into the DTCC if they're not a direct member. But essentially, the infrastructure needs to grow in order for there to be daily trades. And I think that this initial interest will kick that process off and then be ready to start going in a greater extent come October. The second thing that I think will happen is additional use cases. Liz mentioned one. It's one that I'm really excited about. As I mentioned, I work on our fixed income market making desk for U.S. Treasuries. As we've kind of had conversations with different types of counterparties in this working group, different sort of opportunities have kind of popped up. One of which are if you're a stablecoin issuer or a tokenized money market fund issuer, there's been an interest to hold the underlying collateral in a tokenized form. That may be a really good opportunity for a Virtu, who is a market maker in traditional markets, to leverage a Tradeweb platform to make markets in the tokenized version of U.S. Treasuries. And I think that could be really an interesting way to reach new customers and new types of trades that haven't existed before.
Yeah. Yeah. Brilliant. Well, look, this could turn into a day-long offsite, actually. I would quite enjoy that. But we are on the hour, so I'm just going to have to say thank you very much because you've probably got to get on and actually do some of the stuff we've all been talking about. But thank you so much, everyone, for what is, for me, it's such a brilliant mix of present tense, reality, everything coming together. some serious, steps to be taken, but so much that is actually happening right here, right now, that subject to, a lot of constraints, there is this whole mindset shift that is actually materializing, new ways of thinking, new clients, new activities. So thank you so much for making it all seem very real. So I'm sure everyone can reach out to you guys. I'm sure they'll find you on LinkedIn if they want to vehemently agree or disagree with you, but thank you for making the time. And if anyone does have any other questions, then reach out and find us. Thanks, guys.
All right.
Have a
Thanks,
lovely
so much,
day.
Barney.
Cheers all.
John.